So what's interesting, there was a paper that was published recently which talked about this bond equity correlation for your entire lifetime. So for someone like you or T, where you've got a 30-year period, the times when bonds don't help is when inflation spikes. And of course, that's what's happened recently. It's what happened in the 70s. So if you really need an equity hedge, equities really struggle most when there's very high inflation, sometimes with other crises. But the bond equity correlation over long periods of time is actually quite high. So they're not such good diversifiers as we thought. So I think people might have to rethink things like target date funds, about 60-40 portfolios. Because over the long term, over the short term, they hedge stock market falls usually. But long term, over 10-year periods, not so good. So many people, if you're on a workplace pension, you'll be just plonked into one of these 60-40 funds. If you use one of these robo-advisors, you'll answer some questions about risk, your appetite for risk, and they'll just plonk you into a portfolio which is like,
balanced, they call it. The balanced option is typically a 60-40,
and usually that'll be 60-40. Maybe it'll be 80-20 or whatever, but variations of that. So it's just the default option for so many different funds. Advisors, financial advisors, often they do a risk questionnaire and they put you into one of these funds. So I think it's just so pervasive, this idea that your risk is determined by your equity bond split, and that's just the most important thing. Whereas if that's not true, that's a really big deal. That's foundational for so much of people's understanding of investment.
Vanguard was built on that kind of principle. They're very much a defender of the 60-40.
And they're target date funds. Yeah. So the way they work is they have something called a glide path, where you start off with 80% stocks when you're a young lad, and then by the time you're 70, it's 30% stocks. So that glide path is that de-risking over time. And that's built around the idea that bonds are less crashy and safer. Whereas what it actually means, if this paper's right, is underperformance, less money handed on to your kids, and having to invest more to get the same benefits in retirement. So it is a big deal. It's not just a theoretical thing.
What do you think about, so I did some analysis recently of work-based auto-enrollment schemes, and I looked at the default fund options, and I was surprised at the bond allocations in those. So as an example, Nest, they have a grounding period or whatever they call, which is for the first 5 years they de-risk. So the first 5 years you're in the fund in your 20s, basically because I think what they were saying was they didn't want any drops and people running away. And then they also de-risk 15 years before. So in an investing time horizon of 40 years is about 20 years of like tapping the brakes. How do you see that style of like bond allocation?
I think that would be a really bad way of doing it. And I think these target date funds, but target date funds do a very similar thing. You gradually de-risk through your life, and then you end up at age 70 with like only 30% stocks. Whereas this recent paper that's been published, which actually looked at the back tests of, how well does it do if you de-risk with a target date fund, is actually much better to just be internationally invested in equity. So 50% domestic, 50% international. And that actually does a better job of hedging than combining bonds with stocks. So they modeled their social security system and everything was US based. So for them, international means non-US. So 50-50 made sense for them. But for Europe, probably, because it's a smaller market, you tilt more towards US and elsewhere. But what was interesting was the US on its own was not very good, because there's a kind of natural hedge built into your stock market via its currency. So let's say you have inflation spike in the UK, but not elsewhere. That devalues your currency. So when you convert your foreign stock value back into pounds, you get more pounds. And so that means that if inflation spikes, you've got this natural hedge to help you. So it's always good to have that foreign invested money because of that devaluation of your own currency if there's a bad time. Mm-hmm. So that's why international stocks did better, they think. But it's a really good hedge, and it actually had less ruin probability than combining stocks and bonds. So the risk of running out of money was lower. The terminal wealth, when you die, hand over to cash to your kids, was higher by having international stocks, and the wealth at retirement as well. So, on all the metrics, it came out better, which shocked me, because all of these target date funds are built on this premise that, hedging with bonds makes sense, but apparently not.
Why do they do it then?
I think the backtest they do use monthly returns, which seems completely logical, right? You just say, well, what I'll do is I'll look at monthly returns on stocks and bonds, and I'll look at the correlation, and does it diversify? And yes, it does. Whereas if you look at 10-year blocks, this higher correlation between bonds and stocks is what's toxic. And that's what you see if you look over longer periods of time. And no one had done these simulations with this approach. It was something called bootstrap Monte Carlo. Just see if you're awake, mate.
I was like, well, I understood all the words, but I was like, I don't know what they mean together. I'm like, I know what bootstrapping is. I know what Monte Carlo is.
Get into the casino on the cheap.
I started thinking about the casino, didn't I? What's bootstrap Monte Carlo?
But the gist is, you just look at like blocks of time, long blocks of time, rather than short months. And I think Vanguard simulated it with like monthly returns. So they didn't see the kind of toxic effect. Whereas it's the long-term relationship between returns of assets which matters. So that's what was innovative about this paper, I think. I was really excited about it because I like things that kind of contradict what I believe.
Yeah.
And that was very much contradictory to what I believe.
Yeah. There's always this like, the 60-40 is dead. And what you're saying is it might actually be dead.
Yeah.
If you want to hear more about why Romin thinks bonds are sexy, click right here.